Welcome to Smart Stock Watch. Today is May 12th, 2025, and we're diving into the latest earnings report from SGRY Partners, a leading healthcare services company. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. SGRY Partners has just released their Q1 2025 results, and there's a lot to unpack, from revenue growth to reaffirmed guidance. Let's get into it.
Revenue and profitability overview. Let's start with the top line. SGRY Partners reported a revenue of $776 million for Q1 2025, marking an 8.2% increase year over year. John, what are the key drivers behind this growth?
The revenue growth is primarily driven by a 5.2% increase in same-facility revenues and a 6.5% rise in same-facility cases. This indicates strong operational performance and an effective strategy in expanding their service offerings.
And how about their profitability?
Adjusted EBITDA increased by 6.6% to $103.9 million, reflecting improved operational efficiencies and cost management. This is a positive sign of margin expansion, which is crucial for their long-term growth strategy.
EPS and analyst expectations. Now, let's talk about earnings per share. SGRY Partners reported an adjusted EPS of 4 cents, which is quite a surprise compared to the forecasted minus $4. What does this tell us, John?
This is indeed a significant beat. The positive EPS against a negative forecast suggests that the company is managing its costs effectively and capitalizing on its revenue growth. It also reflects well on their strategic initiatives and operational efficiencies.
Operational efficiencies and future outlook. Looking ahead, SGRY Partners has reaffirmed its full-year revenue guidance. What are the implications of this, and how is the company positioned for future growth?
The reaffirmation of their guidance between $3.30 billion and $3.45 billion shows confidence in their growth trajectory. They have a strong liquidity position with $229.3 million in cash and a $388.9 million revolver capacity, which supports their M&A strategy without needing additional debt or equity financing.
And what about their debt levels?
They have a net debt to EBITDA ratio of 4.1x, which is relatively high. However, their focus on operational efficiencies and strategic acquisitions should help manage this leverage effectively.
Key takeaways. In summary, SGRY Partners has delivered a strong start to 2025 with impressive revenue growth and a positive earnings surprise. Their reaffirmed guidance and strategic focus on operational efficiencies position them well for the future. John, any final thoughts?
SGRY Partners is demonstrating resilience and strategic foresight. Investors should keep an eye on their debt levels, but overall, the company is on a promising path.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on SGRY Partners' performance in the comments below. Until next time.